Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this particular video, I'm going to take a look at a screen I ran where I attempted to find fairly valued dividend growth stocks that could offer some capital return potential, that were at least A- rated or better, had moderate debt for the most part, but my real goal here was to try to find companies that, at least one company in each of the broad 11 sectors, and it was quite a challenge. Now, I ended up finding 20 companies that I included in the screen. I'm only going to be covering 11 of them here. But as you can see, I've got one utility, I've got one telecommunication services company, one REIT, two materials, only one in Infotech. Infotech's pretty highly valued right now. I did find several in the industrial sector, however, but again, I'll only be covering one of those for you. And then healthcare, I have one. Financials, I had three. In energy, I had one. Consumer staples, one. Consumer discretionary, two. And then I also included Taiwan Semiconductor, which I won't be covering in this particular presentation. I'm going to start by looking at the energy stock, Exxon Mobil. It's, of course, AA+ rated. It has relatively low debt. Now, one thing I want to say about this particular company is the oil companies all look very similar. Exxon, Chevron, they all look like this. Most companies in the oil services industry, or the, I'll call it energy sector, I should say, have a lot of cyclicality. They're very dependent upon the energy prices, oil and gas prices, which tend to be very volatile. Now, what they have going for them is a very attractive historical dividend record. Exxon is an aristocrat. It's increased its dividend every year, some years better than others. Sometimes it increases their dividend by very high rates when the cycle's attractive, sometimes by very low rates. For example, 2012, it only increased it by 1%. But the average growth of dividend has been about 7%. The company has pretty much ran neck and neck with the market over this time frame. And I want you to notice that even with these earnings falls, the stock price has been, relatively stable. It hasn't fallen or risen very much for the last 2 or 3 years. It's gone from where it was in August of 2015 at 75, and it's currently about 83. So it's not gone up or down, but it has continued to pay a rising dividend. When I'm looking at dividend growth stocks like this, I will focus on operating cash flow. I'm looking here for dividend coverage, and I don't even like to look at price when I'm looking at this metric. I'm looking to see that the operating cash flow is above the dividend, which is the white line. And I'll do the same thing with free cash flow. In the case of Exxon, with free cash flow, their free cash flow has not been covering their dividend in recent years. But the company does have a fortress balance sheet, AA+ rated, only has 10% debt. So they can cover their dividend even when their operating results are not producing the free cash flows or operating cash flows that they need. Anyway, my research candidate in the energy sector is Exxon. The next sector I'm going to cover is the materials sector, and I'm going to look at the specialty chemical company, PPG Industries. A couple of interesting things about this particular graph. You can see how the price tracked earnings. One thing that you're going to see with a lot of stocks, if you looked at as many as I do, you're going to see some aberrant pricing here in the last several years of this bull market. Investor confidence has been very high, but otherwise the price of this company has tracked its operating earnings. There's a lot of, or at least a reasonable amount of cyclicality here. The company does pay 1.8% dividend. It's A- rated, has 42% debt, and after getting overvalued, peaking in its valuation in 2015, the stock has really gone nowhere for the last 3 years. I consider it still fully valued. It was one of the best valuations I could find in the material sector. Again, a very difficult sector to find good candidates on. But anyway, this is PPG. I don't expect it to generate a lot of return from here because, again, I feel the valuation is a little high. But this is the closest thing in the material sector that I would be comfortable even taking a closer look at. I had a couple of choices in the industrial sector. I chose Parker Hannifin here. I had a couple others that I could have shown you, but the thing that I found interesting about this particular candidate was how clearly the stock price reacts to and tracks earnings over time. And then when it does get to disconnected, it always reverts to the mean. And that happened, we had a surge in earnings for 2017 and 18 with Parker Hannifin, and you can see the price, reacted very strongly to that, to the point where it got ahead of itself or overvalued. And then we've had a reversion to the mean. It kind of rebounded again, and now it's back down to an attractive valuation, trading at about 15 times earnings, yielding a 1.8% dividend yield. It's A-rated with only 39% debt to capital. The forecast for growth going going forward is about 9.5%. That would, indicate there would be decent high single-digit rates of return through a combination of earnings growth and dividend for this particular company. And again, I think when you're looking at the earnings and price relationship, the caveats would be when it gets into a cycle, you could see some periods of underperformance, but if you catch it at the right point in the cycle, it can also do very well. In the consumer discretionary sector, I came up with Autoliv. They make airbags and other safety equipment for automobiles. The company trades at a blended PE of 12. Its dividend yield is 2.9%. It's A- rated, has 23% debt to capital. Again, I want you to see this is a sector that is typical to see an element of cyclicality as we have with the previous one so far. You can see during the recession, they were actually forced to cut their dividend. Their earnings dropped and their price followed, but then they recovered very nicely as we came out of the recession. And the auto sector, kind of stabilized and increased. Valuation, the stock price has a lot of volatility. It got very overvalued in 2018. I do consider it undervalued at this point. But again, the cyclical nature of this stock is something that I want to caution you on. The company's forecast earnings growth rate is for 11%. If you look at it from a longer-term trend line, it's still 8%. So the rates of return that this company could generate over the next couple of years are very, very attractive, and it's one that I think would be worth looking further into. It's A- rated, it has 23% debt to capital, and offers almost a 3% yield as of yesterday's close. The next sector is the consumer staple sector. You're going to find a lot of dividend aristocrats here, a lot of high yield, higher yielding, quality blue chip stocks. Kimberly-Clark is A-rated. It does have a high level of debt. I do want you to notice, though, it's got stable earnings growth, but at I'll call it an average or slightly below average rate, depending on what time you measure it. It's been, grows 4 or 5% a year. I think the stock was overvalued in 2015, 16, and so on. Since the early 2017, it's kind of been reverting to the mean. Trades at around 16 times earnings, offers a 3.7% dividend yield. It's expected to continue growing at about the same rate it's historically grown at, somewhere close to 6% per annum. I consider it a high quality candidate, primarily a yield investment at these values and levels. But again, the nature of this particular sector is steady but modest, or I'll say average or slightly below average growth. In the healthcare sector, I present Amgen here. Amgen started paying a dividend in 2011. Prior to that, it was a growth stock, and in fact, it's grown to be the largest biotechnology company in the world. It's A-rated, has a 2.7% dividend yield, has about 55% debt to capital. But I want you to notice the price has been tracking earnings very nicely since we came out of the recession. The company has grown its dividend at a very high rate. However, you got to screen out the fact that they went from 56 cents in 2011 to $1.44 for the next year. So if I shorten this time frame a little bit, you'll see that their average dividend growth rate is still been in the mid 20% range. So it's a company that's growing its dividend very nicely, offers 2.7% yield, and again, it's A-rated with 56% debt. I think it's very attractively valued here at about a 14 PE, which would indicate double-digit returns going forward. The long-term trend line growth is expected to be about 7%. So I think Amgen would be the kind of dividend growth stock you could look at or add to your portfolios today in the healthcare sector. There's a lot of other healthcare stocks that look attractive, but none of them have the A rating that Amgen did, at least that I felt were fairly valued. My research candidate in the financial sector would be BlackRock, Inc., the world's largest money management firm. This has really been a pretty exciting growth stock historically. Over the long run, its average growth of about 19%. But I do want to point out in more recent years, the earnings growth has dropped to about 11%. But regardless, you can see the stock was overvalued coming into 2018, and it's now reverted to the mean to where the valuation is reasonable. The PE is just over 15, offers a 2.9% dividend yield. It's AA- rated, only has 13% debt to capital, and it's really attractively valued. And it does have double-digit growth potential going forward, which could create double-digit returns as we go forward in this industry. It has a very excellent analyst scorecard. It's met or exceeded estimates the vast majority of the time on both the 1 year and the 2 year. A little less on the 2 year, about a 20% hit rate. But regardless, it's a very steady, very consistent grower, as you can see here. Even during the Great Recession, I want to point out, Although their earnings fell, they still had the second most profitable year they ever had, and that was followed by the next year, which became the second most profitable year they ever had, and then it went on to becoming the most profitable years they've ever had going forward. So I think it's a very attractive company, AA- rated, 13% debt. In the information technology sector, I offer Intel. It's one of the few companies in this sector that are reasonably attractive. You can see a level of cyclicality historically. You can see what happened how stocks can become ridiculously overvalued. This was the tech bubble of 2000. But if you look at it in more recent years here, the company's been moderately cyclical, but I'd actually call it moderately growthy, depending on how you want to look at it. It's got a good dividend record going back to 2010. They did freeze the dividend in 2013 and 14. But otherwise, they've increased the dividend consistently. It offers a 2.5% yield. It's A+ rated, only has 26% debt, and I think it's very attractive at a PE ratio of only 11. In the telecommunications services industry, I'm going to present Comcast Corporation. You can see it's had a very nice historical growth rate, averaging 18%. So the orange line on this graph, I want to make it clear, where I've been showing a lot of PEs of 15. This is a PE of 18.4. The company's trading at a blended PE of 15.4, offers a 2% dividend yield. It's A- rated, has 43% debt to capital. It has dramatically outperformed the market historically. The dividend has grown almost at 20% a rate, whether you're looking at compound average or average growth rate. You can see they started paying a dividend as they came out of the Great Recession. I like the earnings and price relationship here and consider this a very excellent time to be investing in this stock. Forecast growth is still considered to be very high at over 17%. It is followed by 10 to 11 analysts. This would indicate a very attractive returns going forward. It might be one of my favorite candidates in the group here. A- rated, 2% dividend yield, Comcast Corporation. In the utility sector, I'm going to present Southern Company. You can see a relatively low growth situation, as most utilities, regulated utilities, are about 3.5% growth. You can see how the price tracks that growth. You can see periods of overvaluation. When you're dealing with a company with this kind of growth, I think it's critically important to only be willing to invest when valuations are low, or at least in line with the earnings. Here we have, a decent valuation, 15.6 times blended earnings, 5.1% dividend yield, A- rated with 58% debt. The company is expected to continue growing at about, long-term growth rate about 3%. Near-term growth rates closer to 2%, 1.5% to 2%. So it's a low growth situation with high yield. But if you were looking to get broadly diversified across each sector, this would be the utility I would look at today. And then the last but not least sector, I'm going to take a look at Simon Property Group, the one A-rated REIT that I recommend. There are other higher, A-rated REITs, but the valuations are very difficult. Retail sector has been under some investor scrutiny lately, but you can see this company was overvalued back all the way through 2016. Then it's reverted to the mean. I consider it very attractive here. Consensus estimates are growth of about 5.5% over the next couple of years. The long-term trend line growth is in line with that, about 6.5%. The company does offer a 4.3% dividend yield. I might point out they did cut their dividend during the Great Recession, but otherwise they've had a very consistent growth of about 8% on their dividend growth rate. But it is a REIT and it is interest rate sensitive. REITs are their own sector now, but as I pointed out in the written portion, there's a lot of different kind of REITs. This is a reasonably valued A-rated REIT that I currently like. So I'd like to summarize this by pointing out what I'm looking here for is that we're talking about diversification with these series of articles that I'm currently doing. So I'm looking for companies across, all the various sectors. And there are some sectors that really just don't have a lot to offer me. I like consistent growth. I like companies that, have very little cyclicality in their histories, but other people can, certainly buy the cyclical stocks. I was looking for quality with this particular screen, so I wanted A-rated or better. I was looking for earnings yields above 6%. And in the case of Simon Properties, where it was a REIT, it actually trades on FFO, so its cash flow yield had to be over 6%, which it met the criteria. So, this is a group of companies that you could literally build a diversified oversight portfolio, putting 1 or 2 companies in each of the 11 different sectors if you were looking for maximum diversification. But frankly, there are some sectors that I personally am not that attracted to and typically don't invest in. But I leave that decision up to each of you. This has been Chuck Carnevale saying thanks for watching. If you like what you saw with Fast Graphs, you can email my associate Polly at the email on the screen here, or you can call us at the phone number. And please don't forget to subscribe to our YouTube channel. We appreciate it. This has been Chuck Carnevale saying thanks again for watching.